Right now, the stock market is closed as it is Sunday evening, but looking back at the final session of the first week of the year, Apple stock finished on Friday, January 2nd, 2026, at a price of $271.01 USD. This was a modest move downward, losing 0.85 USD or about 0.31% for the day. On the surface, it looks like a typical sleepy start to a new trading year, but there is a massive gap growing between what the average investor expects and what the institutional data is actually telling us. Most people see a $4 trillion company and assume it is the safest place to park their cash, especially with the hype around the latest software updates. However, the reality is that we are seeing a significant shift in how big money is positioning itself. While retail traders are busy checking their Robinhood app for the next big jump, institutional desks at places like Fidelity and Schwab are quietly looking at the exit door. The big surprise that most people are missing is that Apple has recently been losing its crown as the most held stock in many professional portfolios, being overtaken by the momentum of Nvidia stock as the primary driver of growth in the tech sector. When you look at the recent trading volume, something interesting stands out. On Friday, we saw about 37.8 million shares change hands. That is slightly below the average we saw throughout December, which suggests that the big players are waiting for a clear signal before committing to the next big move. If you are using a Fidelity trading platform or perhaps checking your positions through the SoFi trading platform, you might notice that the technical indicators are starting to look a bit heavy. Apple stock is currently hovering right around its 50-day moving average, which is about 273.66 USD. Falling below that line on the final day of the week is a subtle but clear signal that the short-term trend is weakening. This is a classic case of the market narrative not matching the price action. The narrative says that the iPhone 17 is going to spark a massive upgrade cycle, but the reality in the charts shows that the market might have already priced that in months ago. The expectation in the market right now is that Apple will just keep grinding higher because it always has. People look at their Fidelity brokerage accounts and see Apple as a permanent fixture, but the reality is that the company is facing a two-front war that it hasn't had to fight in a long time. On one side, you have the hardware struggle. Reports are coming in that production for the Vision Pro has been slashed significantly because the demand just isn't there at that price point. On the other side, you have the software battle. Sam Altman from OpenAI recently named Apple as their primary rival, which is a huge shift. For years, Apple was the platform everyone had to play on. Now they are being seen as a direct competitor in the intelligence space, and they are playing catch-up. This is where the tension lies. Investors expect Apple to dominate any category they enter, but the reality is that they are currently struggling to prove that their specific approach to local on-device intelligence can compete with the massive cloud-based power of their rivals. If you are managing your own money through an individual brokerage or perhaps using something automated like Schwab Intelligent Portfolios, you have to look at the sector rotation happening right now. We are seeing a lot of money move out of traditional big tech names and into more speculative areas, or even into the resurgent energy sector. This is putting a ceiling on how high Apple can go in the near term. Even with a massive buyback program that continues to support the share price, the lack of a fresh, massive catalyst is starting to wear on the bulls. We saw the stock hit a high of 288.62 USD back in early December, and since then it has been making a series of lower highs. That is a pattern that should make any self-investing enthusiast take a second look at their strategy. Comment below and tell me how many shares of Apple stock you are currently holding in your portfolio, and let me know if you are buying more at these levels or looking to trim your position. It's always interesting to see if the community is leaning more towards the bullish consensus or if people are starting to get cautious. To understand why the stock is behaving this way, we have to look at the business model that has brought them here. For decades, the strategy was simple. Sell a premium piece of hardware and then lock the user into a software ecosystem. This walled garden approach created the highest switching costs in the history of consumer electronics. Today, that model is still the bedrock of the company, with the iPhone still bringing in about half of the total revenue. But the real engine of the valuation lately has been the services segment. We are talking about the App Store, Apple Music, iCloud, and Apple Pay. This part of the business has margins that are nearly double what they get from selling a phone. As of late 2025, they reached over 1.2 billion paid subscriptions. That is an incredible number, but it also means they are reaching a point of saturation. It's hard to find new people on the planet who aren't already in the ecosystem, which means they have to find ways to extract more value from the people they already have. This is why the rumors of a subscription-based pro version of their intelligence features are so important. They need a new recurring revenue stream to justify a $4 trillion market cap. If you look at your Interactive Brokers platform and compare the price-to-earnings ratio of Apple to other companies in the sector, you will see it's trading at a significant premium. Currently, the PE ratio sits at around 36. This is high for a company that is growing its top-line revenue in the single digits. The market is giving them a safety premium, treating them more like a consumer staple than a high-growth tech stock. But if the growth in China continues to stall due to local competition from companies like Huawei, that premium might start to shrink. In the most recent reports, China revenue was down about 4%, which is the one major red flag in an otherwise solid financial statement. For those of you using online investing tools or looking for investment help through Fidelity Wealth Management, the focus for the next few weeks is going to be the earnings report coming up later in January. The expectation is that they will show strong holiday sales, but the reality of their guidance for the rest of 2026 is what actually moves the needle. If they can't show a clear path to monetizing their new intelligence features, the stock could easily test the $250 support level. We have seen this play out with other big names too. Look at Tesla stock, which has spent the last year dealing with similar valuation questions as it transitions from a car company to an AI and robotics company. Apple is in a similar transition, trying to convince the world that it is more than just a phone manufacturer. When you are exploring investing sites or using the Fidelity mobile app to track your daily gains, it's easy to get caught up in the minute-by-minute fluctuations, but the bigger picture for Apple is about whether they can maintain their grip on the premium consumer. The premiumization of the market has worked in their favor so far, as people are willing to pay more for the Pro models even if they keep their phones for an extra year. But there is a limit to that pricing power, especially if the macroeconomic environment stays uncertain. We're seeing a lot of people move their assets into Fidelity mutual funds or Fidelity ETFs to get broader exposure, because betting on a single name, even one as big as Apple, feels increasingly risky at these valuation levels. If you are doing your own research on an Interactive Brokers account or checking the Robinhood investment section, you'll see that the analyst community is still mostly on the buy side, with an average price target around $284. However, that target is only about 5% higher than where we are now. That isn't a lot of upside for the amount of risk you are taking on at these levels. This is the disconnect. The analysts are telling you to buy, but their own math shows limited room for growth. This usually happens right before a period of consolidation or a healthy pullback. Looking forward into 2026, the catalysts to watch are the expansion of the AirPods line and any updates on their home robotics initiatives. But the real story is going to be the competition. If you are active in SoFi investing or have a Robinhood crypto account, you know that the pace of change in the tech world is faster than it has ever been. Apple is no longer the only game in town when it comes to high-end hardware. Meta is making a real run at the wearable space with more affordable options, and the traditional search giants are making big moves to take over the digital assistant space that Siri once owned. The central insight here is that while Apple remains a financial powerhouse with more cash on hand than most small countries, the expectation of infinite growth is finally meeting the reality of a saturated market and a changing technological landscape. The stock is in a tug-of-war between its status as a safe haven and its need to prove it can still lead the next wave of innovation. For now, the $271 price point reflects a market that is waiting for proof. It's not a crash and it's not a breakout. It's a moment of deep uncertainty. Whether you prefer the Robinhood trading app, the interactive brokers trading platform, or you like to keep things traditional with Fidelity IRAs, the key is to stay objective. Don't let the brand loyalty cloud your judgment of the numbers. The numbers show a company that is incredibly profitable but potentially overvalued for its current growth rate. As we move deeper into January, keep